All right, folks, it's 5 o'clock. It's time to get started. I see some people still signing in, so I'm gonna give them a minute or so to get going here, just so we get as many people as we can. Doing this. Why do I have this echo? So give me a second. Hmm. All right. Good evening, good evening, good evening. For you on the East Coast, it's early evening. Folks are still signing in. So we'll give a couple of people a couple of good minutes to jump in here for Divas, Dollars, and Financial Decisions. That's what we're going to do today. All right. Stand by, stand by. Get folks in here little by little. Again, good evening. If you just joined us, 5 o'clock came and went a minute ago, but we're going to give everybody another minute or so to get going. Topic is Divas, Dollars, and Financial Decisions, brought to you by the Society for Financial Awareness and myself, that is Lamont Baxter. So I'm going to walk you through this. So, you know what? You guys are on time, so I'm going to go ahead and get started on time here. So, what is this thing all about? Well, had a few friends, family members that said they wanted to talk about financial planning, about retirement planning, about money management, and things of that nature in plain old English. So, that's what this is going to be about. This topic's going to be hopefully lighthearted, fun, but very, very informative. If you are in a position to actually write some stuff down, you may want to do that. I'm going to record this. So if you can't write something down, we'll go ahead and be able to send you the recording if you want it. So stand by. Let me turn on the recording. All right. This thing's going to be recorded. So this is what I'm going to ask you to do. If you got a question, type it in the chat room. If you can't type in the chat room, raise your hand or do something so I can see you, so I can answer the question for you. I want this to be interactive. Right? The topic today is Divas, Dollars, Financial Decisions. What does all of this mean? Right? So, again, people are still joining, so we'll give everybody a few minutes to get in here. But this Divas, Dollars, and Financial Decisions is being brought to you by the Society for Financial Awareness. Right? If you don't know what SOFA is, it's a nonprofit organization. We specialize in financial literacy education. Right? This particular branch is my division that I run. And so I'm going to bring all of this to you. If you have any questions, unmute yourself and ask the questions as we go along. Here's what you don't have to worry about today. This is not a sales pitch. Not trying to sell you anything, not trying to have you buy anything. What I hope to be able to do for you this evening is walk you through some high-level concepts, really easy to grasp, so you can see for yourself whether or not you are on track for retirement. If you're not near retirement, meaning you got a decade or more, are you on track for just basic money management stuff? So that's what this is going to be about. All right. Again, if you got any questions, you can find the chat room and type it. But if it's an intimate group here, you may just unmute yourself and ask the question. I'm going to answer it best I can right away. Again, this is recorded, so that's why I want everybody to stay on mute unless you actually have a question. All right, so let's go ahead and get started with this thing, right? Here's when people talk to me about retirement, what I often hear: a little bit of panic, a little bit about worry. Like, the number one question that people ask me about retirement is, do I have enough money to retire and stay retired? And today I'm going to show you a couple of things to help you self-analyze that. And I'm also hoping that you'll realize that that's really not the best question to ask. The best question to ask is, do I have enough income in retirement so that I can stay retired successfully? So we're going to examine that. But first, I want to show you guys what I would consider the problem to be, the challenge. The main problem and challenge is that people make a lot of their financial decisions independent of their other financial decisions. They don't think about decisions that they made in the past and what impact that may have on the decision that they're going to make in the future, or even when they're making today. I call that thinking in a vacuum, doing stuff, without considering how they're going to impact each other. That normally creates this. Now, I know you guys recognize this. I bet you everybody on here has one of these in their house, right? It's a junk drawer. Well, I would submit to you that you probably, if you're like most Americans and you make these financial decisions one at a time, that you also have in your house a financial junk drawer. Again, it's a bunch of independent financial decisions that are not tied together. So today I'm going to show you how to tie them together, because that's going to make a really big difference as to whether you can retire and stay retired, right? So let's go through how to tie this stuff together, right? Now, here's one of the plans that I use, right? And it's just a sketch of how to do it. You can use whatever you want, but I just want you to understand what you have to examine in order to get yourself from where you want to be to where you want to go in retirement, right? The very first thing that we need to examine is our cash flow. Well, what does that mean? Well, it means while you're working, you generate income, right? But when you retire, you're going to have cash flow come into your pockets. And so right here, right now, I would submit to you that regardless of what your level of assets look like, your most valuable asset is your income. Why? It's the thing that drives your life. Without your income, you can't go on vacation. You can't pay for or buy a house. You can't fund your 401k, your thrift savings. You can't do any of that stuff. And so we need to do something with our cash flow. Some of it, we need to control the debt, right? Now, let's just be grown up about this. If you have $1 and you spend the dollar, guess what you don't have tomorrow? You don't have the dollar. And I'm simply going to say that the number you should be concerned with is 105%. What does that mean? It means that in America, most people live check to check, so they spend 100% of their income, and then they put the additional 5% or more in credit. So I'm going to say this to you so you can stop listening to the talking heads and the financial entertainers. In America, we do not have an income problem. We don't have an income problem. We do have a cash flow problem because people are not managing their income properly. Would you be surprised to know that if you make $180,000 or more, that you are one of the top 10% earners in America? That's a fair amount of money, but it's not a ton. I think people hear the top 10% and they think it's like millionaires. No, $180,000. I think it's 183 to be exact. So we make money in this country. We just spend a lot of it. So understand that your cash flow is king, right? You have income when you're working. When you retire, you have to have assets to generate cash flow to maintain your life in retirement. So that's the number one domain to examine. The number two domain to examine is your debt. Control your debt as much as you can. I'm not going to tell you, I'm not one of them advisors that says, don't go spending money, don't go on vacations. I'm not that guy, right? I am that guy that will simply say, plan it out so that you don't hurt yourself doing it. Make sure that you're not just spending money and letting money disappear off your balance sheet without you knowing where it is and what's going on. The number three domain that you need to examine is called your protection domain. Now, what does that mean? Well, every state in the country, if you drive a car, you have to have some sort of car insurance. You also have to have some sort of homeowner's insurance. The other type of insurance that you have for your property and casualty, in my humble opinion, is something called an umbrella policy. So, what's an umbrella policy? Well, Sarah, I'm so glad you asked that question. This is what an umbrella policy is. Let's say that you are in a house and that you are making $100,000 a year in income. Okay. And let's say that you are a 50-year-old person and you're going to work until the age of 67. That means you have 17 years to work, right? So if you were going to work for the next 17 years and you make $100,000, you never get a pay raise, cost of living increase, or any of that. You stay right there. You're going to generate $1.7 million. Now, why am I showing you this? Well, I'm showing you this because, and here's your first homework assignment. I want you all to examine your car insurance. Again, I'm not trying to sell you car insurance because I know you got it, but I want you to examine your policy. I want you to find the declarations page, and I want you to see what it says the insurance company is contractually obligated to pay if you get in a car accident with someone else and it's your fault. What I typically see is 30, maybe as much as $50,000 per person, and it might be 50,000 up to maybe 300,000 per accident. Maybe there are multiple people and it's a serious accident or whatever, but that's what I typically see, right? So let's say that you're in an accident with this person here, making 100 grand a year. They're scheduled to make 1.7. And let's say you got the big number, 300,000. Well, if the insurance company gives this person 300,000, they're still missing some money because they're saying they can't go back to work. $1.4 million is what they're missing. Where do you think that money is going to come from? They're going to sue you. And if you don't believe me, tomorrow, maybe not tomorrow, Sunday, but during the week, watch daytime television. I guarantee you there's going to be some attorney on there saying, hey, if you get in an accident and you're injured, don't call the insurance company, call us. We'll get you more money. This is how to get you more money. They literally sue you, not the insurance company. And the thing is, they will come after your assets. And if you don't have the assets, then they'll come after your income or your cash flow to satisfy that judgment. Or you can pay about $30 a month to get you an umbrella policy, and you can take that risk off the table. So why am I showing you this? It's important for you to understand that we have to make sure that your income while you're working is uninterrupted and your cash flow in retirement is uninterrupted. That's how you're going to be retired successfully. The next level of protection is around your health, right? Again, if you are young, if you're not near retirement, do you have any disability insurance? Like if you can't go to work because of a prolonged injury or prolonged illness, do you get dollars into your pay account while you are out, right? I'm not talking about sick leave. I'm talking about long-term. And then also you have your medical insurance, and there are some government plans. Like you could file for disability through the Social Security program, but let me tell you, that's a hard nut to crack. You have to be really down, and they typically don't give people disability after the first try. A lot of people have to actually get an attorney. Then the last thing in the protection domain is your estate plan. So hear me well, folks. If you're on this webinar, I'm going to assume that you have some income. And if you have some income, I'm going to assume that you have acquired or built at least one asset. That asset could be your couch. I don't care what it is. If that's the case, congratulations. You have an estate. You need an estate plan. 100%. What would happen to you if you pass away? Where are we going to bury you? Who's going to get your stuff? Cover that with a will. What would happen to you if you were incapacitated and you can't make a financial decision or you can't make a medical decision because you can't speak? Well, if you're married, your spouse may be able to take care of that. If you're not, who's going to make these decisions for you legally? You need to have durable power of attorneys. You should also have an advanced medical directive. So if you are in a situation where you're really gravely ill, do you want to be resuscitated? Do you want to be on a ventilator or not? And then maybe some of you need a trust. It's worth investigating. But at a bare minimum, you need that. Oh, and if anybody on here has kids going to college, they need to have durable power of attorneys because when they turn 18, they're legal adults. So you can't make those decisions for them when they're gone. So you got that. That's all the stuff that's in domain number 3, which is the protection. Next is savings. Savings is real simple, and I don't want you to confuse savings with investing, okay? When you save $1 on top of $1, it grows, even at 0% interest, because $1 plus another dollar is $2. However, when you invest $1, sometimes it grows and sometimes it shrinks. It depends on what the market's doing. So we need a saving strategy. What does a saving strategy look like? How much am I saving on a consistent basis every paycheck, every month, or every year? Is it 5, 10, 15, 20% of my income? I get my clients to get up to about 20 to 25% of their income in saving, and to a certain degree. Why? Because if you have money, when an emergency shows up, you don't have to go into debt to deal with the emergency. So we have to figure out how consistently we're going to save. And then we have to figure out whether we're saving in a taxable environment, meaning every time the money grows in the savings, you got to pay another tax. Is it a tax deferred or postponed environment, meaning you don't pay taxes until later? Or is it in a tax-free environment, meaning that the money grows and you never have to pay taxes again? That's what we have to look at in savings. And guess what? When we get to the growth thing, which is what everybody loves to do, we got to look at the same thing. Taxable, tax deferred, tax free, what kind of asset allocation do we have, all that kind of stuff, right? So those are the 5 domains that you need to examine. So now I'm going to give you 7 steps that will encompass how to examine these domains to make it real simple. Again, if you're taking notes, this is going to be helpful to you. If you have any questions, please feel free to, you can go in the chat room or just unmute yourself. We got an intimate audience, so it's not that big of a deal. So here are the 7 steps we're going to walk through. Understanding your target retirement income. I'm going to teach you about asset allocation, real high level. We're going to talk about some risk that you have to be aware of in retirement, such as a withdrawal risk, sequence of returns risk, and we're going to talk about inflation, the cost of any rising medical costs in retirement, and then what required minimum distributions look like. Maybe some of you know what they are, but you will be expert in it at the end of this webinar. So here we go. What's a target retirement income number? Well, like I said, people ask me all the time, how much money do I need to retire? And my response to them is, how much income do you need to live on? On the back of a sheet of paper, on a napkin, here's the simple way to figure it out. Step 1, how much money do you make a year? Gross. This is before you take taxes, before you pay anybody anything. How much do you make a year? Gross. Now I want you to subtract out of that gross. This person makes $107,000 a year. This person is spending $24,500 to fund a retirement account. It's either a thrift savings plan because they're in the government or a 401k because they're not. Doesn't matter, right? So that's what they're doing. So we're making 107. They're spending 24.5 to put into a retirement. They're putting another 6,500 into an IRA, which is an individual retirement arrangement. They are paying into Social Security like all of us are. They have to pay $66.34. If you want to know how much you're paying into Social Security, it's one of two things. It's going to be 6.2% or whatever your salary is. Or if you just look on your paycheck stub, look for a line that says OASDI, which stands for Old Age Survivors Disability. This is Social Security. That's what they're taking out of your check, so you'll know. So that's what this person is doing. They also told me that they have some credit card debt that's about $6,500 a year that they're going to have paid off before retirement. So that's step 1, identify that. Step 2 is this. When this person, this is a woman, when she retires, she can't contribute into her 401k. She cannot contribute into an IRA. You have to be employed to put money into a retirement account. You will not be paying money into the Social Security system unless they change the law. And she said she was going to have these debts done. So I'm going to add all of this up. And when I add it up, it comes to this number, 44,134. I subtract that from the 107. And what do I have left over? $62,866. This, ladies and gentlemen, is what I call your target retirement income number. And here's why. Number 1, this is your current lifestyle. This lady is really living off of 62,866 because she's not living off this money. It's going somewhere else. So she won't need it in retirement. Number 2, if we can hit this $62,000 in retirement, she won't have any change in her lifestyle. Most of the people I work with when they're getting ready for retirement tell me if they can maintain their current lifestyle in retirement, they'll be happy. That's the desire for most people. So that's step 1, identifying what the target is. Now, what's step 2? You got to flip the paper over or the napkin, whatever you're using, and we go to step 2. Now we have to identify, where's this money coming from? So are you going to work part-time or get a full-time job in retirement? Some people do that. They do layered retirement. Do you have a pension? Is that going to provide income for you? How much Social Security are you going to get? Do you need to pull money from your retirement accounts, like your IRAs or 401ks? Do you have some real estate that's generating income, or are you going to sell some and use the proceeds? So you have to know in advance, at least have an idea what you're going to use to generate income in retirement. Once you do that, you can put it step by step. So here's my example for this young lady. She has a pension because she works for the government. So she's going to get $25,000 a year of guaranteed lifetime income. She's also going to get $25,000 a year in Social Security income. She saved up $500,000 in her retirement account. So she can withdraw 2.7% of the $500,000, which equals $13,500 a year. And when she adds that all up, it comes to $63,500. Now, sidebar. If you don't work for the government or a federal agency, you probably don't have a pension. Maybe you work for a company that does have a pension. They're typically not that large. It just depends on the company. If you don't have a pension, then we should investigate whether we can create one with you from the assets that you have been built, right? So don't get thrown off by this pension. I know some people will and some people won't, but this is the scenario that we're going with. So when you put these two things together, you can see what they're spending today to maintain their lifestyle. And we can see that they can get to $63,500 without any stress, which means they're going to retire and be in the same lifestyle, which is what most people want to do. So that's your target retirement income number. Anybody got any questions, comments, or concerns? Go ahead and do them now. If not, I'm going to move to the next thing. You can type it in the chat or you can just unmute yourself and ask me any questions for clarification. All right, so I guess you have no questions. I either did a great job or you're very shy, and I don't think that's the case, so let's move on. The next thing you need to understand is your asset allocation, right? What does that mean? Well, pretty simple. How much money do you have in the market versus how much money did you have out of the market, right? And now let's talk about the stuff that's in the market. Now, when I say in the market, I mean things that are being invested into assets that go up and go down because of market activity, right? So let's look at this. I call this the investment quilt, right? Looks like one of those quilts the grandma used to make. At least my grandmother used to make them. Well, actually, it was my great grandmother. But I digress. What these little colors represent are different asset classes. So I know that you all have heard you have to have a well-diversified portfolio, right? So I think most people know what the S&P 500 represents. If not, I'm going to tell you. S&P stands for Standard and Poor's, and the 500, it's the top 500 companies in America. Now, you may be surprised to know that January 1st, you have the list of 500, and by December 31st, the list may change because some companies may fall out of the top 500, or some new companies may work their way in and push some companies out. But that's just one asset class. There are a lot of different asset classes. You have commodities, right? That's your orange juice, pork bellies, things like that, and agriculture stuff. You have intermediate bonds. You have short-term bonds. You have high-yield bonds. You have diversified. You have mid-capitalization, small capitalization, large capitalization, foreign stuff, mid. So what I want you to take away from this is every color on this quilt represents a different asset class. So now going forward, when you hear you need to be well diversified, this is well diversified, meaning you have something in all of these asset classes, including real estate. That's not even on here, but there's something called real estate investment trust that you can invest in real estate without owning real estate, or you can own it yourself. Why am I showing you this? Because I want you to know, first of all, that you need to be diversified. And being diversified doesn't mean that you have a bunch of different stocks. It means that you have a bunch of different asset classes. And the second thing that I want you to get through your head right now is you're not going to be able to time the market. It doesn't work. And here's my proof. What we're looking at here are the asset classes available from the year 2002 to 2021. And what I want you to look at are the colors. Can you tell me if there's any rhyme or reason as to when a specific color is going to show up in any given year? In 2002, the highest performing asset class was commodities at 25.91%. In 2023, the best asset class was small capitalization growth companies. But let's go back one year, and where was the small capitalization growth companies in 2002? It was a negative 30%. So you got negative 30% in 2002. If I'm sitting down with you before we go to our New Year's Eve happy hour on December 31st of 2002, and I say to you, hey, you like the small cap stocks? And you're going to say, no, man, these things went down by 30% because, you're well informed and you know how this stuff works. And I would say to you, I don't know if that means anything, but okay. And then at the end of 2003, it has a 48% to the plus. That's a 70% swing, which means that there's no rhyme or reason to this stuff. You can't time it. You can't guess it. This supports my theory of being well diversified, because if you own everything, when the highs are highs, you take advantage of it. When the lows are lows, the highs take over the lows. This is a negative 30 to a positive 48. And there's no way to figure out where it's going to be the next year. The next year, it's heck, I don't even see it on it. Next year is 9%, or whatever. So my point here is you can't time the market, right? When I first got in this business, it's been almost 2 decades. One of the things that I used to do was buy the magazines of all of the great investors that were in the marketplace so I could learn from them. And after about 5 years, I discovered something. I wasn't looking at the same two people every year. They caught lightning in a bottle and they just happened to get it right that one time. So what I'm telling you is that you have to be perfectly right when you sell your assets and perfectly right when you buy them if you're going to do market timing. And I don't think anybody within the sound of my voice has the time to do that. I believe you all have your own professions and you won't have the time to do the research to put this in place. You have to control your behavior. Let me give you an example of what that means, right? Sorry. Over the last 30 years, the S&P 500 has done about 9.03% right here. Okay. But the average investor only got 4.1%. Well, why is that? Because they tried to time the market. And when you jump in and out of the market, what happens is you miss. You don't hit the target because you have no idea when this stuff is going to go up or go down. So diversification is the key. Further proof is this. Let's pretend that somebody had all of the asset classes that I just showed you from 1973 to 2021. Well, they would have gotten, if you dropped a lump sum in here, it'd have been 10.99. Most people are doing this incremental, meaning that you're putting money in every paycheck into your retirement accounts. So let's just focus on the incremental. Your rate of return will be 10.72%, right? But what would happen if just one day from 1973 to 2021, any one day in that time frame, you missed the top performing asset class? You dropped from 10.72 to 7.76. And what happened if you missed two of the asset classes? You dropped from 10.72 down to 5.16. So this is investor behavior. So what I want you to take away from this is you cannot time the market. It will not work. It always leads to a lower rate of return. So if you have a diversified portfolio and you just ride the wave, you're going to get the best rate of return, right? So that is your asset allocation. Let's move on to point number 3. Well, before I do that, any questions or comments? Type it in the chat, unmute yourself and just say something. Nope, we're good. All right, let's move to point number 3. What's point number 3? Let's examine some of the risks that people have to be aware of on the way to retirement and in retirement, right? They're all on the screen. We have to worry about laws. We can't control the laws. They're going to be what they're going to be, but that's part of risk in retirement, right? Longevity, withdrawal rates. I'm going to go into that in great detail. Income taxes. We got to talk about taxes, right? The stock market, long-term care. We're going to talk about this, but here's the big 4, right? The big 4 that you really have to pay attention to will be longevity, income taxes, stock market, and inflation, right? So let's get to what it looks like with those. We'll start with the withdrawal risk. So a withdrawal risk is simply this. You've accumulated some assets. Now you're retired and you have to start pulling money out to live on. That's the withdrawal. What's the risk? Well, the amount of money that you pull out and how you have your asset allocation will dictate how successful you may or may not be. Okay, so let's look at the withdrawal rate. We'll do a quick examination. Let's say that you saved $500,000 for retirement. And let's say next that you need $65,000 to live on in retirement, right? That's your target retirement income number, close to what we had in our last couple. Where's that 65K coming from? Well, this person is going to get a pension for $25,000 and they got Social Security for $25,000. So that's $50,000. So they're short $15,000. Where's it going to come from? Well, if they pull the $15,000 out of the 500,000, that's a 3% withdrawal rate. What does that mean? It means if they have all of the money in the market, right? Well, and let me back up. What's the asset allocation on these portfolios, right? See this front number that says 100? This is equities. This is stocks, stuff that's in the market. If you work for the federal government, this is going to be your C fund, your S fund, and your I funds. And the zero is stuff that's not in the market, like bonds. Now, bonds are in a market, but they're not as volatile as the stocks. And it's also your cash that you may have in money market accounts or saving and checking accounts. So the front number is equities or CS&I fund if you're in the government. The back number is bonds and cash, or again, if you're in the government, it's the G and the F fund. Okay. I like to make this conversation real simple and say this. The front number is stuff that is in the market, meaning it's exposed to all kind of market volatility. And the back number is stuff that is out of the market, meaning it's got an interest rate for the most, and it's going to grow a little bit, but it won't be a lot of volatility. So I'm just going to say in the market and out of the market to make it simple. So that's the first thing. That's how your assets must be allocated. The second thing is, what's the withdrawal rate? Well, since this person needs 15K, 3% of 500,000 is actually 15,000. So they need a 3% withdrawal. They're going to pull 3% from the $500,000. Now, this study called the Trinity University study has taught us that for about a 30-year window, depending on the withdrawal rate, we know how successful an investment portfolio will be. If this person needs 15K, then they could have all the money in the market and nothing out, or they can be real conservative and have 25% in the market and 75% out. That's a very conservative portfolio for retirees. A lot of retirees want to be in a conservative portfolio because they don't want to be exposed to a lot of market risk. And that makes sense. I get it. It makes sense. So this person can do that. But what if you are a person that does not have a pension, right? So using these same numbers, we got to make up $25,000. And so if we have to make up $25,000, that means that we're going to have to withdraw more money from the asset. And if we withdraw more money, your need now is 40K. What's $40,000 from 500,000? Well, ladies and gentlemen, that's an 8% withdrawal rate. What's the success ratio on that? 44%. That's not good. So let me give you an analogy so you can kind of wrap your head around what I mean by that's not good. Because you guys attended this webinar, I'm going to give you, each one of you, a first class ticket to anywhere in the world. That's your congratulations for coming. All right. So let me get my attorneys told me that I have to give you this disclaimer. You will not be getting any tickets from Lamont Baxter or anybody that works for his company. This is just an example. Okay. So now that you got your ticket, you're on the plane, you're sipping on your libation, and the pilot comes on and says, hey, the weather is beautiful wherever you want to go, and the flying time is however long it takes to get there. But I have to give you this one disclosure. There's a 66% chance that I'm going to crash this plane on the way to your destination. Are you going to stay on that plane? I don't think so, unless you've been overserved with libations. And even then, I think you might be smart enough to get off the plane. So what I'm telling you is, why would we set our retirement accounts in a manner by taking too much money out or putting it into a conservative position to put us in a place where we may run out of money? And so we have to figure out what is the need. Now, all of this stuff that I'm giving you can be done on the back of a napkin if you are somebody like me. If not, you probably need to talk to somebody like me, right? And I'm going to give you an opportunity to do that, but I want to show you what you need to be talking about if you want to talk to me or anybody else. You don't have to talk to me. If you talk to somebody else, this is the stuff I want you to talk about, right? This is what I want you to talk about. Now, so let's look at this withdrawal rate sustainability, right? Here's that 8%. That money would last about 12 years. So I guess if you retire at, let's say, 65, you know, and or if you want to retire even younger, if you're going to drop dead in the next 12 years, then yeah, it doesn't matter if you need the money. right? But I work with a lot of people, and I've yet for anybody to tell me when they're going to drop dead and be right. I mean, I feel blessed because my mother and my father and my wife's parents, they're all still here, and they're in their late 70s and early 80s combined. So they've already exceeded this, right? So we kind of feel like we're going to be hanging around for a while. You take your personal family history and you figure out what it looks like for you. But we have to take this into consideration. Now, what's the next thing that you need to know is a risk, right? It's called sequence of returns risk. And this really is just something about market volatility, right? So, sequence of returns risk. So, first of all, let's understand what market volatility is. And I think you guys know, but let's simplify it. Volatility is when the market makes a dramatic move up or down. That's all volatility is. And so you all should know that there's going to be volatility because there always has been. Here's a real short glance at history from 1942 to 2020. You can see the market going up and down all over the place. And just so you know, the little silver bars in there are recessionary periods. So markets can go up in recessions and people can still make money. If you're going to be listening to the talking heads on TV or the financial entertainers that want to sell you books and CDs, there's some terms you should know. Pullbacks, corrections, and bear markets. What does that mean? A pullback means the market dropped 5 to 9%. A correction is 10 to 19%. And a bear market is 20% or more for a sustained period of time. Why do you need to know this? Thank you for asking. Well, when you're in retirement, sequence of returns has a very unique risk because now you're in retirement and you're withdrawing money from the portfolio to live on. Here's someone that retired with $1 million in 1973. They found out that their portfolio had a negative 14.67%. Can anybody tell me when they found that out? Well, they found out when everybody else finds out. You don't know what your rates of returns are going to be until December 31st on any given year, right? You have to go through the entire year, and then at the end of the year, you know what your portfolio did. So this person had a negative 14.67%. Throughout the year, they were spending money to live on for income, almost $80,000. The next year, they had another negative loss. They didn't find out what it was going to be till the end of the year, and they continued to spend the money. Why? Because they needed to live on. So here's my question for you. Let's pretend like this is you and your money. You started out with $1 million, and after 2 years of retirement, at the end of the second year, you got 519. That's a 48% drop in your portfolio balance. You've lost almost half the money. You spent some, but the rest of it is lost to the market. How are you feeling about being retired now after 2 years? Probably not so good. Let me tell you the three things that I see people do when they find themselves in this position. Number one, they go back to work because they feel like they can't afford to stay retired. I don't know anybody that said, hey, I want to retire and I want to go back to work in 2 years. That's not what people want to do. But some people are forced to do it. Number two, they live a smaller life. What do I mean by that? Well, this person was taking out almost 80 grand. Now, instead of 80, maybe they drop it down to 39,000 because they're afraid of spending the money. Again, not a comfortable way to live in retirement. Number three, what they do is they leave whatever they have in there and they put it into a more risky portfolio because they feel like they can get some gains. Well, this person was almost right because the next 2 years, a plus 37 and a plus 23. That's pretty good. And that brought them back up to 648, but that's still not $1 million. Now, they continued this way for 19 years. They were able to get an average rate of return of 12.98%, which if I told you as your investor or your advisor, give me your money to manage and I can get you close to 13% as an average, you probably would say, where do I sign? But I'm here to tell you that average rates of returns are mathematics and they're not money. They really don't mean as much as people put stock in. I don't mean stock is in stocks, but credence in. Let me use another word. Because this person got a 12.98%, they were able to spend $1.5 million over 19 years. But at the beginning of the 20th year, they were out of money. That's a failed retirement. their portfolio is gone. The reason that this happened partially is because this withdrawal rate is too high, but mainly because of the sequence in which these rates of return showed up. The danger zone for retirement, in my mind, is the first 10 years. The more negative rates of returns you have in the first 10 years, the higher the probability is for you to run out of money. And here you see 1, 2, 3, 4 negative rates of returns in the first 10 years. Here's the really bad news about this. I cannot control what the rate of returns are going to be in your portfolio, and neither can you. No one can, because it's whatever the market delivers, whatever market you're invested in. Now, just so you know, I'm not making this up, let's change the sequence, right? Let's see what happens if we don't have 4 negative rates of return in the first 10 years. See what the result is with the same money. So now we got 1 in a 10-year span, started with the same $1 million, but look how much money they have after the second year, even with a negative year. They have the original million plus $86,235,000, and that's after spending almost $80,000 a year. That's pretty successful. They go on, and all the bad stuff is after the 10 years in the back. They got the same 12.98%. They spent the same 1.5, but they still have 3.7 to continue retirement. So again, the challenge is we don't have any control over the sequence in which these rates of return show up. So Lamont, there's got to be a solution. Of course there is. Would you like me to tell you? Only because I like you, I'm going to do that. Here's the solution. If you are in the market and you're pulling money out of your retirement account and you experience a negative year like he did here, then once you realize that, I'm going to sit down and say to you, next year, we can't pull money out. So 1973, they were pulling this money out. At the end of the year, we've realized what we had. I said, hey, next year, you can't pull any money out of this portfolio. So they didn't. We experienced another negative. They couldn't pull any money out of the portfolio, so we didn't. The next year they got a positive. We can now turn the money back on because the portfolio is up, so you can pull money out in this year, right? So that's how that works. You get positives, you pull money out. You get negatives, you don't. So you should be asking yourself, if I don't pull money out of this retirement account, where do I get it from? Because I showed you before that they spent $1.5 million, but since they didn't pull money out on these years after the market was bad, here they only spent 1.1. How did they maintain their lifestyle? There's $398,000 that they didn't spend from this portfolio. That means you have to have another source to pull the money from. So if you go back to my asset allocation page, remember I said there's stuff that's in the market? Well, this is stuff that's in the market. It's going up and down. And when the market goes up, you can spend the money out of here. Conversely, when the market goes down, you take a zero, which means you got to have another bucket over here. And I call this my principal protected account. This is the account that has some kind of interest rate or something that makes the money grow without the market, so you don't ever have a downturn. And you take the money from here. And then when the market goes back up again, like it did here, you simply replace the money that you spent from your principal protected account in here. So that's part of the asset allocation, understanding the withdrawal. So by now, folks, what you should start to see is that there are layers to this thing, and they all kind of go together. There's not this stick your head in the sand and hope it's going to work out thing. You literally have to do some planning. So again, if you don't have an advisor, we can talk. I can give you this stuff. You can take it to your advisor. If you have one, you can have an opportunity to talk to us. We'll give you some information. That's the defense. Because what happens here is when you don't take the money out of this, your portfolio survives and you stay retired. So that's the sequence of returns risk. Now, let's talk about inflation. What is inflation when you're talking about retirement? Well, in retirement, it's a real cost, and it's something that you can't control. It's a real cost when we're working, but it's certainly a real cost in retirement. What do I mean by that? Here's a real simple example. In 2022, if you purchase something for $100 in 2023 because of inflation, it costs $104, $104.92 because we had a 4.9% inflation rate. You have to put this on your income, right? Things cost more in the future. than they do today. Things cost more today than they did in the past. All you got to do is look at stuff. That's what inflation is. So when we look at your income, right? Let's say you got that $63,500 of retirement income, right? Well, in 2023, you would need 66,611 to continue to maintain your lifestyle, to keep up with the cost of living. So that means if you started with 63.5 in 2022, you need 66,611. And in 2025, at the beginning of the year, you're going to need 73,299 because stuff costs more. So the only way that you can keep up is you have to make more. So that means that you have to have your assets in a place where you're exposing some to the market so to keep up with inflation, and your safe money, the principal protected stuff, the stuff that's not exposed to market volatility, still has to outpace inflation in order for you not to lose spending power. That's what this means. Now, why is this a risk? Because we're living longer again. So the longer you live, the more inflation you're going to be exposed to, which means we have to have a remedy for this. Here are the stats as of the beginning of this year, right? 82, if you make it, if you make it to 65, right? 82% of the man, I mean, you live a lot longer. And women live longer than men, right? Married women live longer than married men. So however you slice it, women are going to be around a lot longer. So we have to make sure that the money doesn't run out, not only for ourselves, but for our spouses when we leave this planet. Right? So that's something else that we have to look at. Now, let me introduce you to the most dangerous thing to your retirement portfolio. It's the thing that puts people in bankruptcy and retirement more than anything else, more than everything that I've taught you so far. And that is long-term care. Right? Right now, if you reach the age of 65 or you're older, 70% of Americans are experiencing long-term care. So first of all, what is long-term care? If you need help with any of these daily activities, they call them the 6 ADLs, right? You might be in a long-term care event, right? But you only need help if you need help for 2 or more. That's when you know you're in trouble. Do you need help getting out of bed, moving from one room to the next, using the restroom, taking a bath, a shower, dressing, or eating? It's up on the board. If you say yes to 2 or more than this, who's helping you? If you have a loving spouse that's willing to dedicate his or her time, it may not cost you anything. Unless, of course, your spouse is still working and now they have to take off and they may exhaust their sick leave and now you're missing pay. Maybe you're retired and there's no work to be had, so you're in good shape. But what if you don't have that luxury? What if you're by yourself and you got knucklehead kids that don't want to be bothered with you? Who's going to do this? You're going to have to pay somebody. Here's some of the average cost of what it takes to pay for a long-term care event. Right? You could spend up to almost $137,000 a year. That's the average today. So how do people pay for long-term care? Right? Well, let me walk you through a couple of methodologies. One of them is they pay out of pocket. I hear people say this all the time. I'm just going to self-insure. I have a robust retirement account. We got money in the bank. We can afford to pay it. If you can afford to pay it, that's awesome because you get the care where you want it for as long as you need it in any environment that you want to receive the care, meaning at home, in a daycare facility, in a nursing facility. You get that, right? Here's the downside. You might run out of money. And if you run out of money, well, you won't be able to get the care. Now you have to rely on the government. What's the problem with relying on the government? Well, for me, it's twofold. Number one, it's different in every state because the government long-term care program is not really a program, but it's a joint effort between Medicare and Medicaid, which means it's state and federally run. So it's going to be different in every state. You need to do the investigation as to what it looks like in your state. But the other thing with relying on the government is you can't have any assets. You can own your home, you can own a car, and about $2,000 in liquid assets. Everything else must be exhausted before they spend a penny. You can buy a long-term care insurance policy. That used to be a really good way to deal with this, but quite frankly, they're very expensive because of that whole, 70% of people over 65 now taking advantage of these programs if they bought them earlier. So the insurance companies have had to raise the prices. It's not cost effective. One of the most cost-effective ways that I see of dealing with long-term care is people that buy permanent life insurance and write into the contract some way of accessing the money if they have long-term care. You can also use annuities, you can use assets. So I want you to understand that there are different ways to deal with this. The number one takeaway from long-term care is this. I don't know if you'll need it. I know if 7 out of 10 people need it over 65, the probability is high, but I would want you to have a plan in case you need it. Because if you don't need it, congratulations. But if you do, have a plan, have a strategy. Here's a little checklist of things that I would want you to do so you can ask yourself about this long-term care, right? What does it cost in the state that you live in or that you're going to retire in? Assessing your finances, which is all that I've been talking about right now, right? Make sure that you share your plans with your family, because if you're not in a place where you can, if you are cognitively impaired, then it'll be good if they know what's going on before that happens. All right, and get your legal documents in place. So now the last thing we're going to talk about is something called required minimum distributions. What does that mean? If you're like most people in America, this is what you have been doing to prepare for retirement, right? You have been going to work and you have been generating some income. And you've been able to break some of that money off and put it into a tax deferred bucket. What do I mean by that? That's your IRA, or maybe you've been putting it into a 401k, right? Or maybe if you're in the government, you've been putting it in a thrift savings plan, the TSP. There are a bunch of other programs, et cetera, et cetera. And so the dollars that you put in here, you didn't pay any taxes on the money that you put in there. And that money grew while it was in the bucket, and you still didn't pay any taxes. That's what we call tax deferred. I like to call it tax postponed. It's not until you pull money out of this bucket that you now have to pay income taxes. And you got to pay income taxes at whatever the income tax rate will be when you retire. So here's my first question for you. What's the income tax rate going to be when you retire? Well, unless you're going to retire in the next year or two, you have no idea. You have no idea. So that could be a problem. But the bigger problem is this. If you did do this, which again is the majority of what Americans do, then at a certain age, you're going to be introduced to something called required minimum distributions. This is when Congress and the IRS have gotten together and said, at a certain age, we want to take RMDs out of this bucket, meaning whether you need the money or not for retirement, we're going to pull it out of this bucket. Why? So we can collect the income taxes. So, ladies and gentlemen, there's a tax train a-coming, and it's coming with a vengeance. So when will your required minimum distribution start? Well, it depends on the year in which you were born. If you were born 1960 or later, then it starts at age 75. 51 to 59, 73, 1950 or earlier, 72. If it's earlier than that, it's 70 and a half, right? So I'm going to assume that, we're probably in this age 75 bracket. Maybe somebody is here with the age 73, right? That's how RMDs work. So what does that mean? Here's the chart. Now I want you to notice that the orange graph grows every year. Why? Well, here's somebody that at age 75, they had about $500,000, right? This is our bucket. And so they had to pull 4.6% out to satisfy the required minimum distribution. Now you get to spend that money, right? But they force it out so they can collect the taxes, right? And guess what happens? The orange graph is growing. And so that means at age like 60, at 85, it grew to 6.25. And so we're all here at 75, we'll all be paying RMDs. This goes here. But then you get out here to 85 and it grows to this number. And it does that every single year as long as you're working. And guess what? It's 100% taxable. Now, why is that a problem? Well, what do you think income tax rates are going to do in the future? Now, the election's over. The Tax Cuts and Jobs Act is scheduled to run out January 1st of 2026. But since the previous administration is now about to become the new administration, they may expand it. And if so, we'll still have historically low income tax rates. But that's a bit of a problem for a couple of different reasons. And here are the reasons, right? They have to go up at some time in the future. And how do we know that? Well, let's examine what's happening in the past so you can see how I come. Now, this is my opinion based off of the facts, the historical facts. We started paying income taxes in 1913 at a rate of 7%, right? Congress was going to cap it at 10% back then, but they decided we don't need to do that because we'll never get that high. Well, we got here at World War One, and it was almost 80%. And then the next time it went up was World War II, where it was over 97%. Then it dropped down, but it got back up here during the Korean conflict and during Vietnam. So, what I know from a historical point of view is that whenever America is engaged in any kind of war in the world, our taxes go up and they go up exponentially. Well, if we get out here to 2024, right, we are now in World War III. We may not be sending boots on the ground, but we definitely are sending dollars on the ground. So it tells me that these taxes are going to have to go up at some point in the future, or we're just going to run out of money, especially when you put it on top of the fact that, well, we have a debt and deficit that's in the trillions. Such a big number, people can't even wrap their head around it. So I don't know how we're going to pay the credit card bill if we don't do this. That's what's going on with taxes. Now, if you want to know what the average tax rate is historically, it's 57.3%. So if we don't do anything but get up to the average, right, we're going to have a much higher tax bracket. Why am I telling you all of this? Because if you're in your age where you have required minimum distribution and they're forcing the money out, you're going to be in a higher tax bracket. So let me walk you through so you can see what it looks like. Here's Sue and Bill. They retired at the age of 62. Sue has a pension of $18,000 and some change. She's taking a withdrawal rate, right? So you can see how all of this works together of 3% from this bucket, her IRA and TSP. So she's withdrawing 3% of that money. And her husband, Bill, is withdrawing 4% of his IRA. And they're hitting the target. While they were working, they were making $62,000. In retirement, they're going to generate $63,000 of income. So their lifestyle doesn't change. This is their target, right? And so they're hitting their target with a little bit extra. Where are they in the tax world? Well, they're married, filing jointly, and so their income falls in here, so they're in a 12% bracket. Great. Now what happens when they get to RMDs? Here's the first thing that happens. The first thing that happened is, remember, Sue was taking 3% because that's all she needed? Well, now because this R stands for required, not recommended, not requested, it's a requirement. Sue is now taking 4%. Bill was already at 4%. They're the same age, so he can stay there. But remember, this is going to go up next year and the year after that and the year after that on both of them. But they're starting at 4% with their RMD. They have Social Security now. So in theory, between their Social Security and the pension, they don't need to take anything out of these buckets. But again, the R is required, so they don't have a choice. So they're pulling the money out. Look at their income, 134. So some people say, well, that's great. Why is that a problem? Well, it's a problem because it is. At $134,000 of income, they're no longer in the 12% bracket. They've now been bumped up here to the 22% bracket. That's a 10% jump in income taxes. And I've been very generous because I didn't give them any inflation on their income. So let's go back and give them some inflation on their income. It's going to grow so they can keep up with the cost of living, and their assets are going to grow. They're really at about 224. Well, where does that put them? 224 puts them in the 24% bracket. So what I'm telling you folks is you got to understand this stuff if you really want an opportunity to win, right? Just knowing how the stuff works gives you a chance to remember. Here's a little checklist. You can identify where the money's coming from, right? We understand the withdrawal rate. We manage all the risk that I just walked you through. For you, we have to address your specific risk. You may have a long-term care situation looming or not. You may have a withdrawal rate looming or not. We have to address it specifically. And if we're looking at tax strategies, having a conversation around Roths, right? Roth IRAs, Roth TSP, Roth 401k, maybe even permanent life insurance, because that's a Roth strategy. But understanding what you can do to avoid giving all your money to the tax man might be a good idea. So here's my number. Here's my stuff. You guys, if you want to reach out to me, I really encourage you to, set an appointment. It's absolutely free. Let me tell you what the appointment is going to look like. I'm going to ask you some questions. We're going to go through some information, right? I'm going to build a model out for you. And when I finish with the model, I'm going to deliver it to you. And it's going to be absolutely free. And the reason I'm going to give it to you for free is because if I do that and I answer your questions, if you don't have an advisor, you're probably going to ask me if you can work with me. That's how confident I am that I'm going to give you the information that you need to get from where you are to where you want to go. Now, if you can do it by yourself, God bless you. Do it. Knock it out. I ain't mad at you. But if you feel like you need some help, I want to make myself available. So what I'm getting ready to put into the chat room right now is the link. If you want me to build you a model for free, go into that link, set an appointment. That it'll open up my calendar and it'll tell me that you were here and that's what you're looking for. And I will do that for you. And then after that, you can say, Lamont, let's work together. Or you can say, Lamont, I don't ever want to see you again because you are an idiot. And I will accept that because my wife tells me that all the time, but she's stuck with me. So, nah. That's where we're going, right? Now, I'm going to put in the chat room one more thing for you guys, if I can find it real quick, and that is the PDF version of these slides. You all hopefully were taking some notes, but if I pull up the slides or give you the PDF version and you can match it with the slides, it may be a little helpful. Let's see, this is the PDF. So, yep, in the chat room, you can download what I just put together for you guys. Again, I hope since you took the time on a Saturday to join me, this was worth your time, energy, and effort. Again, I'm open for you if you want to talk. Let's make it happen. If you have any friends that you think would benefit from this, if you email me and ask me, I have this recorded. And so I will share the recording for a limited amount of time. I don't like to let them hang out there for a long time because, legislative risk means that the laws change and some of the stuff may be outdated by the time they look at it. I would also invite you to follow me on social media, right? I'm on LinkedIn. I'm on Zoom. I mean, not Zoom. That was stupid. I'm on YouTube, and I'm going to post this out there to YouTube, as well as Instagram and all that kind of nonsense. I'm on all that crap. So if you find me, do that. I mean, really, follow me if you can. So does anybody have any questions or comments, either in the chat or just unmute the mic yourself? I'll listen to you, talk to you, and if not, I'm going to give you back the rest of your Saturday evening.
Hey, Mama, this is Sarah. I just wanted to thank you for that information. Very informative. I'm definitely going to hit you up and kind of let you go over my portfolio and see what we can do. Very, very good information. I knew some of it, but not all of it in detail like you have. I have a very unique situation. That's why I said we'll go over my information together. So I'm gonna hit you up probably sometime this week. I'm actually rolling out, about to jump in the car right now because we have somewhere we have to go to.
Of course you do.
But I appreciate. I just want to come on and tell you how much I appreciate the information.
No, sis, I'm glad you could make it. I'm glad it was helpful. So I'll see you.
Definitely gonna hit you this week to talk to you more about my financial situation.
All right. Well, I'm looking forward to it.
All right. I'll talk to you. And I got the slides too. I was screenshotting my ass off and I didn't have to because you gave the slides. So I'm good.
All right. Cool beans. So anybody else got any questions or comments? If not, I'm going to give you back your Saturday night.
I want to say I appreciate it too, Lamont. This is really, really informative too. So I'll reach out.
Awesome. I appreciate it. All right. Well, you guys enjoy the rest of your weekend. And I'll see you when I see you. Peace.